Hello and welcome. This guide is brought to you by the experts over at My Tax Accountant. Today, we're going to pull back the curtain on a tax that a ton of UK investors pay, sometimes without even knowing it exists. It's called Stamp Duty Reserve Tax, and we're about to break down exactly what it is, how it works, and how it impacts your investments. So let's get right into it. So think about the last time you bought some shares. You saw the price, you hit buy, you looked at the final cost. But did you ever spot that tiny extra charge, that little fraction of a percent tacked on? Well, that's the tax we're talking about. For most people, it's just skimmed right off the top of the trade, a small but very real cost that just flies completely under the radar.
To make sure you've got the full picture, here's what we're going to cover. First, we'll nail down what SDRT actually is. Then, we'll look at the nitty-gritty of how it's calculated and paid. We'll also clarify who's responsible for it and, this is the big one, how you can legally lower your bill. And finally, we'll talk about the risks before showing you exactly where to get expert help.
Right, let's dive straight into Section 1. What on earth is this paperless share tax? Okay, so at its heart, Stamp Duty Reserve Tax, or SDRT for short, is basically a tax you pay whenever you electronically buy shares in a UK company. It was specifically designed for the modern world, where we all trade with a click of a button instead of signing a physical piece of paper. And here's a cool little bit of history for you. SDRT isn't some old, dusty tax from centuries ago. It was actually created back in October 1986. And this was timed perfectly with what the city called the Big Bang, that huge moment when the London Stock Exchange moved from traders yelling across a crowded room to quiet, electronic, screen-based trading. The government needed a new way to tax these paperless deals, and voila, SDRT was born. Now, people often get SDRT mixed up with its older sibling, regular stamp duty, but they're definitely not twins. See, SDRT is for pretty much all modern electronic trades. It's collected automatically, and the 0.5% tax is calculated right down to the last penny. Traditional stamp duty, on the other hand, is for those rare cases where people still use a physical paper form. The rate is the same, but it's rounded up to the nearest £5, which is a subtle but important difference. And wow, this chart really shows you just how big a deal SDRT is now. In the last tax year, it brought in almost £2.3 billion for the government. Compare that to old school stamp duty, which was under $1 billion. It just proves that if you're investing today, SDRT is the tax you need to know about. It's a massive source of revenue and a key part of the UK's tax system. So now we know what it is, let's get into the mechanics. Section 2 is all about how this 0.5% tax is actually worked out and paid. The one number you really need to remember is this, 0.5%. It's a simple, flat rate on whatever you pay for the shares. So let's say you buy £10,000 worth of stock, your SDRT bill is going to be exactly 50 quid. It's a one-off cost, but if you're someone who trades a lot, that 0.5% on every single purchase can really start to add up and chip away at your profits. So how does HMRC actually get this money? Well, for most of us, it's completely automatic. Your broker's system, which is called Crest, does all the work for you. It calculates the tax, deducts it, and sends it off to HMRC. It's totally seamless, just like what happened with Jane. But, and this is a big but, if you're doing a private off-market deal, it's a whole different story. You're on the manual route, and that's where people like Tom get into trouble. You have to do everything yourself, and if you forget, you'll get hit with a penalty, making it a very costly oversight. And that brings us perfectly to our next question. Who is actually responsible for making sure this tax gets paid? Let's break down the roles here. Okay, let's clear this up, because it can get a little confusing. At the end of the day, you, the buyer, are the one paying the bill. But for most standard trades, it's actually your broker who is legally on the hook for reporting it and paying HMRC. The responsibility can shift, though. If you're a business owner running an employee share scheme, you could become liable. And as we just saw with Tom, if you're an off-market buyer, the whole thing, calculating, reporting, paying, it's all on you. And even when the system is supposed to be automatic, it's not always perfect. Just listen to what happened to Raj, an investor from Birmingham. He realized his broker had actually overcharged him for SDRT. It goes to show that glitches can happen. And you know what? It took him 6 long weeks to sort it out with HMRC and get his money back. It's a really great reminder to always check your statements. Just because it's automated doesn't mean it's always right. Okay, we've covered the what, the how, and the who. Now for the bit you've probably been waiting for. Section 4. Let's talk about how you can legally and smartly slash your tax bill. All right, here's a massive pro tip for every single investor listening. The easiest, most effective way to legally avoid paying any SDRT at all is to do your trading inside what are called tax-advantaged accounts, or tax-free wrappers. These are special accounts the government created to encourage us to invest for the long term. So what are these exemptions? Well, there are actually quite a few, and some are incredibly powerful. For starters, any trade under £1,000 is automatically exempt, which is great for smaller investments. But the real game changers are trading inside a stocks and shares ISA or a SIP pension. Any shares you buy in those accounts, completely free of SDRT. You also don't pay it on things like government bonds, when a charity is buying, or, and this is a good one to know, when you buy shares in a company's initial public offering. And this right here, this is the magic number, £20,000. That's your annual ISA allowance for the 2025 to 26 tax year. And every single trade you make inside that allowance is completely 100% SDRT free. Honestly, for most investors in the UK, using your ISA allowance is the absolute best strategy for building a tax-efficient portfolio. Okay, saving tax is fantastic, but we have to talk about the flip side. It's so important to be aware of the pitfalls. So in Section 5, we're going to cover the risks of getting SDRT wrong. And this story from Priya, a fintech owner in London, is a real cautionary tale. Her company's accountant made what seemed like a tiny administrative error. They accidentally filed a £500 SDRT payment as a payroll expense. The knock-on effect was huge. HMRC's system freaked out, put her staff on emergency tax codes, and it created a total nightmare that took 3 months to fix. It just shows how one small SDRT mistake can have a massive ripple effect. So what are the direct financial hits if you mess up? Well, for a late off-market payment, there's an instant £100 penalty. On top of that, HMRC will charge you interest, and that rate can add up fast. And if you're on the other side of it, say you've overpaid and you're owed a refund, you'll need to be patient. It can easily take 4 to 6 weeks for them to process it and get your money back to you. Which brings us to our final section. Getting expert help. You know, after everything we've talked about, it's pretty clear that while SDRT seems simple on the surface, the details and the risks mean it's something you want to handle with confidence. So let me just ask you, after hearing about all the automatic deductions, the manual responsibilities, the potential penalties, the crazy payroll pitfalls, are you feeling just a little bit overwhelmed by it all? Because it's totally understandable if you are. But here's the good news. You really don't have to figure all this out by yourself. For anything complex, like an off-market deal or a business share scheme, getting professional help is absolutely the way to go. And that is exactly why my tax accountant put this guide together. So if you want that peace of mind that comes from getting expert advice on SDRT or really any of your tax questions, please don't hesitate to reach out to the fantastic team at My Tax Accountant. You can get them on WhatsApp or call them on 07854 255 375. Or just send a quick email to info@mytaxaccountant.co.uk. They'll give you clear, professional help to make sure you're both compliant and as tax efficient as possible. And finally, for more brilliant, practical guides just like this one, make sure you hit that subscribe button on their YouTube channel. Thanks so much for watching.